Good morning, everyone. We're just waiting for a few more attendees to join. Welcome to our webinar today. We're going to get cracking in a few seconds. So just bear with us and we shall start shortly. Right then, we're going to get started and get cracking. Today, we're going to talk to you a little bit about how to avoid the common mistakes with UK buy-to-let. My name is Sanjit Danjal. I'm the Managing Director of the Opulent group of companies. And with me today is going to be Ben Lane. And together, as well as being grossly overweight, we have the delightful pleasure today of being your host and to talk you through today's webinar. So what are we going to talk to you about today? Well, first of all, we're going to tell you a little bit about ourselves. We are an award-winning property investment company, trusted by over hundreds of investors from all over the world. We've been around for over 10 years and sold well over £1 billion of UK property. So in terms of an agenda for today, the first thing we're going to just quickly run through is the common mistakes and what we feel are the common mistakes UK buy-to-let landlords make. And it's worth pointing out here that these mistakes are not from the internet. They're not, from speaking to other people. These are mistakes that we, over the 10 years of being in business, and myself being in the property business for over 25 years, are hearing from our investors. These are the types of issues we're hearing from our landlords. And so we've kind of summarized it into 5 or 6 areas. And really, guys, if you pay attention to these and listen to what we're about to say, not only can you make better, more informed decisions, but you could also save a hell of a lot of money. So before we get started, there will be an opportunity to ask us questions at the end. We will have a Q&A session, but in the spirit of saving time, we will keep the questions until the end. But if you want to drop us a question along the way, I believe you can do so throughout. And what we'll do is we'll try to endeavour to answer those questions at the end. So yeah. First thing though, before I want to start, is I'm just going to put a quick poll up. We always like to know who are the types of people who are attending our webinars. So if you could quickly just let us know what best describes you here. I'm just about to publish that. That would be really good. But yeah, we'll give you a few seconds to do that, everyone. But yeah, just let us know what word best describes you. Okay, so moving swiftly on. What are the common mistakes? Oh, sorry. What are the common mistakes that we see our landlords and investors making? The first thing I wanted to mention, and this is perhaps the biggest, is following the crowd. And I'll go on to explain a bit more about that. But really what that's about is blocking out the noise around us and what other people are telling us, what the media are telling us, etc. The second thing I'll go on to talk to you about is not doing the right research. It always amazes us here at Opulent how many investors invest without doing the right research. So we're going to talk to you a little bit more about that and tell you what you need to be looking at and give you some pointers on how you can save money by doing the right research. Following that, if Ben can eventually join, we're having a few technical issues here. But Ben's going to talk to you a bit about legal and compliance. That's a biggie. Compliance and legislation is always changing around buy-to-let and property investment. And so we're gonna touch a bit on that. We're going to talk about purchasing in the right structure. This is perhaps one of the questions we get asked most here at Opulent. Do I buy in my own name, or do we buy in a company name? Then we're going to talk about whether or not to leverage or not. And then finally, we'll talk about the biggie, which is taxation. I'm going to put this out there right now. We're not qualified to give tax advice, but we will give you some pointers on what you need to look out for. And that one really, if you're on top of your game here as investors, then you really can save a lot of money. So that's us. That's what we're going to be talking to you today about. We're going to try and keep it to about an hour and wrap things up within them. We appreciate a lot of you have got things to do. You're all busy people, so we'll try and keep it short and sweet. I'm going to keep it at a relatively high level. There is so much more we can talk to you about this stuff, but we don't have enough time now. But if any of you want to talk to us more about any of this, then please feel free to get in touch with us and let us know. We're happy to help. Okay, so the first section is following the crowd. Now, what do we mean by this? I'm going to put up a quick slide, and what we mean by this is this, precisely this. Being scared or listening and reading the headlines being published by the mainstream media. Now, I don't want to generalize here, because I don't wish to tarnish all articles, all publishers, all editors with the same brush here. But a lot of the time here, in our experience, most of the mainstream media, when they're putting out media articles like this, they're basing it on research that has been done on relatively small data sets. And then perhaps incorrectly, they're using this to generalize the entire property investment industry. And so as investors, a lot of us will look to this, we'll look at these headlines, and a lot of us will be scared off. And it's not just the bad articles here. You'll see the first two articles are negative, but the third article is talking about something positive, but even that is questionable. And so what we always advise our investors is to maybe kind of block out a lot of these kind of mainstream media and articles, and kind of, rather than tuning out, tune in. And what we mean by that is spend some time to really understand exactly what it is you're trying to achieve, what your investment goals are, what your journey is, and then make your decisions accordingly based on that. I mean, these guys who are writing these articles, they don't know what your personal circumstances are. They don't know what predicaments you're in. They don't know where you're at on your journey. And so it's kind of wrong of us as investors to use these articles and generalize what's going on in the industry. I'll give you an example about this. Those articles, that some of those which we showed were from last year, and granted, in some areas prices did grow. Sorry, did fall last year. And on the flip side, there was also lots of areas that where prices grew. But if you ask the majority of people on what they thought happened to house prices last year, I'm going to tell you that house prices fell. They did in some areas, but they didn't in others. But the media are generalising it, and so we often tend to believe this. But I can tell you now, in amongst all of the doom and gloom last year, we had investors that were still making 8 to 10% on capital appreciation by investing in the right areas. And why they did that is because, to some extent, they blocked out the mainstream media. I'm going to talk to you a little bit about friends as well. In particular, the friends that profess to know it all. We come across a lot of investors that we deal with on a day-to-day basis, they often tell us that they've been advised to invest into projects because their family members have or their friends have, and usually what that involves is people kind of getting you to invest in projects because they want to feel safe themselves, i.e. safety in numbers. Often they've heard about hotspot areas, or what they think are hotspot areas for some of their other friends, and they're just spreading the word. And the issue I have with this, and Ben, you can maybe jump in here a little bit now that we've fixed your technical issues. But the issue I have with this is that these friends who profess to know it all and give us advice, again, they're giving us that advice based on their own individual circumstances, or based on the person who's told them about this particular area on their circumstance. They don't necessarily know what you're trying to achieve, the reasons why you're investing in property, but yet they're trying to tell us that, you know, a particular area is the best place for us to invest. Is that something you come across a bit, Ben?
Yeah, exactly. It is, because obviously, you know, we always want to, seek advice from, friends and loved ones who, have invested in properties before, but, not necessarily asking someone who's, say, bought in London 25 years ago. Mm-hmm. Obviously, their experience is going to be very different from buying the same property in the same location right now, mm-hmm. because the market's ever evolving and changing. So it doesn't necessarily mean that that's the best course of action for you and your personal circumstances moving forward. So yeah, I completely agree.
Absolutely, and I think also when we come across clients like this who've been told things about from their friends about, let's say, some of the more popular destinations to invest into property. A lot of it is hype, a lot of it is media, and actually a lot of the time the people who invested in that market maybe 5 or 10 years ago, the ones who have really cashed in.
Absolutely.
And now that all of the mainstream investors are arriving, most of those smart investors are cashing out because they've made their growth, and the people who are investing now may not necessarily have a lot of upside in terms of capital appreciation. So again, when we say don't follow the crowd, what we're talking about here is finding the right investment locations that will give you growth, not necessarily those mainstream locations that have already seen the most of their growth. Take some time to understand why you're doing this, because ultimately the decisions you make are going to be based on what you're trying to achieve. And remember that your goals are unique to you. Remember all of that, and do your best if you can, guys, to tune in as opposed to tune out. So that's the first section. The next section we're gonna move on to straight away, and this again is another very big area, Ben. I mean, you tell me how many investors you come across on a daily basis or weekly basis that think they've done the right research but actually haven't.
Yeah, absolutely. I mean, it's a very common, issue that we have with investors who, come because they, as I heard something through the grapevine, and they want to do a certain kind of investment, but actually that particular one doesn't actually fit their circumstances, that well, actually. Mm-hmm. So doing your research beforehand, finding out what kind of areas and also what kind of properties mm-hmm. work for you is absolutely paramount.
Absolutely. I wholeheartedly agree. I mean, this stuff here, what we're about to talk to you about, ladies and gentlemen, is the stuff that our sourcing team, the guys who find our projects, are very well rehearsed with. And these are the sorts of things that we're looking at to ensure that we provide our clients with the best possible investments that have been researched well. So the first thing we're going to talk to you, and guys, once again, I could probably spend the next 2 hours talking to investors about this. It warrants that much time, so I'm gonna kind of skim through it a little bit. But in a nutshell, the 4 things we're going to talk about are researching the project and the location, which is, goes part and parcel with being a property investor. Researching the developer, in particularly if you're looking at investing off plan, you need to look at your developer and their track records. You need to research the costs. Again, another one that we come across a lot is investors not budgeting correctly for their property investments and being caught out by unnecessary costs or unwanted costs that they simply didn't know about. Again, working with a credible agent here, they should be able to advise you accordingly and manage your expectations here. But when you're investing yourself, guys, you really need to be aware of the hidden costs so that you budget appropriately. This is the last part we're going to talk about, and this is a strange one, some of you might think, but researching your agent as well as your solicitor, what we found is very, very important. Sometimes agents have their own agendas, they have their own areas they're pushing, and solicitors I'll go on to talk to about a little bit more shortly. solicitors, quite frankly, are falling short in terms of the research they're doing and the reporting they're doing to their clients. Is that something, Ben, that you found?
Yes, definitely. Because I mean, as with, again, a lot of things, people are always driven by price.
Mm-hmm.
And you do, with solicitors, you definitely get what you pay for. And some of the solicitors at the cheaper end, quite often they miss out, certain things, and it's not ideal.
Okay. So let's talk a little bit about researching the project and the location. Here, what we're really talking about are researching those things that investors can get caught out on. So first of all, in terms of the location, really what we're talking about here are our 4 pillars of success, what we call them. And that is regeneration. Now, investors need to do their research on this. Whether they're buying through an agent or whether they're buying separately, they really need to do their research on regeneration, i.e. to what extent within the local vicinity of that development is it regenerating? How much money is being pumped into new infrastructure projects, new roads, new railway and transport links, new offices? How many new businesses are starting up in that area? Because as and when businesses come into an area, they bring with them people. Population grows as a result, and so population growth within an area is a good indicator of potential demand moving forward for rental, but not only rental, in terms of resale as well. So guys, I can't stress how important this is. I mean, this particular section, these 4 pillars here, really are the fundamental basis of all of the projects that we look at here at Opulent and showcase to our investors. These types of this information is all widely available in the public domain, and you can access information like this from council websites. You can look at secondary research. There'll be a lot out there, but really familiarize yourself with the location you're purchasing in, and the likely demand for both property for sale in the area as well as property for rent. Look at education establishments, look at whether there's a university in the area, whether or not the graduates from that university are being retained in the area, in which case they're going to need new properties to rent or purchase, etc. So have a look at that. And as well as that, have a look at, how close your property is to railway links, bus links, amenities, restaurants, bars, things like that tenants love to frequent. So when you're looking at location, really, that's what we're talking about here. Again, there's so much more I can talk to you about, but we're going to move on in the spirit of saving time. Next, what I would advise people to look at is the project, and with the project here, really what we're talking about is costs. Service charge. Does service charge apply? If so, how much is the service charge? What's that service charge being spent on? Look at the track record of service charge and how it's increased over the years, and the management company's ability to refurbish buildings, carry out works efficiently, and do them, in a cost-effective way. And essentially, you need to look at the terms within the lease that govern how service charges increase over time. A lot of the service charges will increase in line with RPI, the retail price index, or inflation, as it's more commonly known, over a given period of time. So they review them every 5 years or every 10 years, and they're increased in line with RPI. Others can be a little bit more trickier, and they can increase more. And if, for example, the management company can't manage the building well, or are doing a poor job in managing the building, then expect your service charges to go up. Additionally, expect service charges to be increasing at the moment because of the rise in energy costs, although they're talking about that coming down, and we're starting to see that filter through into service charge budgets. We need to really be looking at that, because those are the sorts of things that can quickly spiral out of control and eat into your yield. We as a company, we're very particular about service charges, because landlords, investors are liable to pay them. And if they get out of control, then that net yield that you earn can quite quickly disintegrate. So those are the types of things you want to be looking at when you're looking at researching the project or researching the location. Next thing we're going to talk about is the developer, in particular the developer's track record. Whether it's built, off plan, whatever, you need to make sure you're working with a developer who is credible, has a good financial standing, has many past projects under their belt. You need to be looking at the speed at which they're building these projects, whether there are any delays, whether they've factored in the likely rise in the cost of materials right now that a lot of developers are facing. You need to look at the people behind those companies. Where did they work for before? Which other projects have they been involved with? It's super important to partner up with developers who can deliver. Time and time again, guys, have we come across investors who haven't done the right research, followed the crowd, and quite simply didn't research the developers they partnered up with, and as a result had no end of grief with projects being delayed, projects not completing, rent not being paid on time, etc. So it's really important, guys, to again work with credible developers, and once again the Opulent clients can benefit from that. We work with tried and tested developers who we've worked with in the past, and developers who deliver for us. So that is a very short summary of the type of research that you need to be doing as investors. There is a lot more, as I've discussed. Ben, anything to add on that?
No. I think you've kind of covered the main points on that, and doing your research is absolutely paramount, and especially as you mentioned, I think on the actual developer themselves, because time and time again we get clients who have been burnt and had kind of really bad experiences.
Good. So that's it for me for the time being. I'm going to hand over to Ben now, who's going to talk about yet again another big topic for landlords and investors, and that's legal and compliance requirements of being a landlord.
Yeah, thank you very much, Sanjit. So legal and compliance, obviously making sure that when you let a property and when you obviously purchase the property, it's ready to be let and is habitable, is absolutely key. Now, the reasons why landlords can be potentially burnt, there is a plethora of different reasons. So, for example, a couple of years ago, the largest fines that were issued for non-compliance, for example, there was one landlord who was issued a £66,000 fine because their HMO licenses were non-compliant. The largest fire safety breaches, there was a £90,000 fine for one individual landlord. And there was even one landlord who had a 9-month prison sentence because they didn't have proper fire safety checks and smoke alarms. I think they only had one smoke alarm in a 5-bed HMO, so they actually went to jail for 9 years. Yeah. So that's why.
It's often quite easy for us, Ben, is it not, as investors, to kind of forget the smaller detail like this.
Absolutely.
Particularly if we're not working with a reputable property management company, then it's quite easy to see how landlords are getting caught out here, particularly as though this is an evolving landscape and legislation is changing all the time.
Yeah, exactly. And even with, the Renters Reform Bill that has recently come in, which we'll obviously move on to. The landscape is changing and evolving all the time. So, for example, with property laws and regulations, here are the kind of main points. And again, all of this information is, kind of free to access online. But, it's kind of stated that, first of all, you need to keep your property safe and free from hazards when you let it. So that's all listed under the Defective Premises Act of 1972 and basically outlines the legal obligations of the landlord to make sure the property is safe and secure for people renting it. So gas and electrical equipment. So every time you rent a property, there has to be an EICR report done, as well as a gas safety inspection. If this is not done, again, you're in breach of the law and could be fined. Every time you rent a property, a new energy performance certificate or an EPC has to also be implemented. So the current minimum for renting a property within the UK is actually an E rating, but that is rumoured to be increased to a C rating moving forward. So again, when you're looking to purchase properties, you need to bear in mind that probably buying something with a C or higher rating would be advisable, knowing what legislations are coming in moving forward. So fire safety. So again, I kind of touched on that with the fines that were issued previously, but again, this is absolutely paramount. So you need to make sure that there's fit and tested smoke alarms throughout the property. If you're buying a HMO, that means there has to be in every room. You have to make sure that there's fire retardant doors. The windows are safe, so it means that if people are on the first floor, they're able to get out if there was a fire on the lower floor. And that you also have to check the regulations within the building. So if you're buying a leasehold property, making sure that all the fire checks have been up to date, and I'm sure you'll be able to get that from any building manager. And then obviously with every time you rent a property, there has to be a health and safety inspection, which kind of covers all of those previous points. And then also within the tenancy agreement. So every time you rent a property, there has to be a legal tenancy agreement if there is a tenancy longer than 3 months. The things that it needs to contain are listed within the Housing Act of 1988, including maintenance obligations. And also you have to legally provide a document called How to Rent to every tenant that you rent a property for. So then moving on to the next slide. There we go. Sorry, to move back one. So tenants' rights and protection. So again, this is a very, very important aspect of legal and compliance, because tenants' rights, that's actually a very, very big subject right now. And you need to know what rights the tenant has, moving forward. So first of all, the big one that we found as well with some of our investors is deposit protection. So when you take a deposit from a tenant, you can't just put that in your own personal bank account. That has to be in a recognised, protected account. And in fact, we actually had one investor who rented their house out to a group of students, and basically the students didn't treat the property too well. And then at the end of the tenancy, they had a number of kind of maintenance issues that they needed to be fixed. And they were looking to get that from the deposit that the tenants had left. However, because the deposit was not put in a protected account, it meant that they had to return the deposit in full to the tenants and then pay for the maintenance works on top of that. Wow. So that's why it's absolutely key putting your tenant's deposits in a protected account, which obviously a management company would do for you. But if you were to let yourself, then you do need to you do need to notice that. So the second point, again, this is one that has come in recently with the Renters Reform Bill, is the end of Section 21 evictions. So essentially what this means is that you can no longer evict your tenant if there's been no wrongdoing. So, for example, if they haven't trashed the property. So if, say, for example, you were renting a property and then you're with a tenant and they were 6 months into the tenancy and had another 6 months left, but then you wanted to increase the rents, or maybe you let one of your children move into the property, you're now legally no longer able to do that. And then when it comes to the actual details of the tenancy themselves with the Renters Reform Bill, so an end of fixed term tenancy, so what they're proposing is moving forward, you won't be able to rent a property for a fixed term of 12 months. It has to be more flexible with a kind of minimum 3-month term, and then it'll be monthly rolling. And also there can be no blanket bans on tenants with children as such. And then on top of that, there is proposals for a new landlord ombudsman as well, that tenants would be able to go to if their landlord was causing them issues. So other rights that the tenants have is to obviously live in the property undisturbed. So if you have a tenant and you're going around kind of every couple of weeks to check up on them, unfortunately that is actually technically illegal under the law. They're also protected against unfair rent rises. I mean, this is quite a sort of open-ended kind of point, because obviously what kind of determines an unfair rent rise. It's not actually written out exactly how much that percentage is, but it's obviously worth noting that that has actually been outlined in the law. So if you have a tenant and you're looking to increase the rents by 40%, then realistically you'd probably have to wait until the end of the tenancy to do that, and then get a new tenant in. You wouldn't be able to do it during the tenancy. However, they also must keep the property in good condition. So whilst it seems that landlords are being penalised a lot, you do also have rights yourself in terms of how the tenant keeps the property and how they maintain it.
Interesting.
So moving on to the next slide. Well, move it forward. Wait, sorry.
I'll do this.
Yep. So moving back to, yes, the other legal requirements. So when it comes to property management companies, so with property management companies, it is absolutely paramount that you choose a good property manager to actually manage your tenants and also manage the property. So you've got to make sure that they're, first of all, ALA compliant, because quite often because we have our own management arm, and quite often we go to investors and ask if they want us to manage the properties for them, and obviously we get a number who do. Then quite often we get investors who say, well, I've got a management company that'll do it for 5% or 6% for the full management. Now that kind of rings alarm bells, because if there is a management company that is willing to do a job that cheaply, are they going to make sure that the property is maintained to a good standard? Are they going to be on top of maintenance issues, and so on and so forth? So that's why it's absolutely important that you make sure that you get a property management company that is compliant with all the legal and compliance issues, and that keeps on top of things. And then again, taxation. So Sanjit will speak about this in more detail, but obviously to comply with laws and regulations, you have to make sure that your tax is in full order. And then coming on to insurance, to cover yourselves and protect yourselves against unforeseen circumstances is absolutely paramount. So I've listed obviously a number of the different insurances that you can get as a landlord. So landlord insurance is basically the equivalent of building insurance, protecting against the actual structure of the property. You've also got property liability insurance, covering if the tenant is injured and sues the landlord, which is obviously highly unlikely, but it's worth knowing that it's there. And then the other ones like rental guarantee, making sure that if there is a loss of income due to a fire or damage to the property, that your rent continues. And then obviously contents, flood, and obviously umbrella insurance as well.
Yeah, it's worth pointing out here, ladies and gentlemen, that a lot of this stuff can be quite daunting, or seem quite daunting, and seem like you've got so much to do as landlords, and in some ways, people could be put off by this. But if you partner up with the right agency, the right management company, then they will have all of this stuff covered for you. So don't be too put off by this. It's all kind of mandatory, done by the agents. However, if you are thinking about managing your properties yourself, then you are going to need to take note of all of these things.
Yeah, absolutely.
Good stuff. So on to the next section now. Again, Ben's going to talk to us a bit about this, but I would say possibly one of the most popular questions we get asked here at Opulent by our investors is, how do I purchase this property? Should I put it in my own name, or should we purchase it in a company name? So what we're going to attempt to do now is unravel that, and Ben's going to talk us a little bit more through this.
Absolutely. Thank you, Sanj. So buying in the right ownership structure. So obviously the first and most obvious structure that you have is sole ownership. So when you buy the property, it's just in your name and you own it outright. So it's obviously the easiest way of buying a property, because you have kind of full control over all aspects of the purchase. However, there are some downsides to buying in sole ownership compared to some of the other structures that we'll come on to. So, for example, your income is taxed on top of your normal income. So if you are a 40% taxpayer, then quite often buying a property in your own name doesn't make any sense whatsoever, because 40% of your income goes immediately to the taxman. And then if you're buying with a mortgage as well, they have got rid of mortgage interest tax relief. So what that actually means is that you'll be taxed 40% on the gross income before the mortgage has even been deducted.
Right.
So that's why if you are a high earner, sole ownership probably isn't the right structure. But if you say are an international investor who doesn't have any UK-based income, then sole ownership probably makes the most amount of sense.
Yeah.
Or if you're buying a property, say in a relative's name or your partner's name, then that quite often makes a lot of sense. So then moving on from that is obviously joint ownership. So that's where you partner up with either one other person or maybe 2 or 3 other investors to purchase the property together. So again, this actually has a lot of benefits, especially when it comes to the affordability of getting finance on the property, because what the bank will see is they will see that there's 4 people who are jointly responsible for paying back the mortgage rather than just one. So you quite often get much more preferential rates when it comes to getting a mortgage. However, obviously the drawback of joint ownership is that you all need to make sure that you're on the same page. Because if obviously one person wants to sell and then the other investors don't want to sell, then that can get quite tricky, and then changing ownership of that can be costly and inefficient.
Absolutely.
So then moving on to the next slide, which is probably definitely is actually the most popular way of purchasing properties at the moment, is through company ownership. Now, the reason why this has been the most popular way of buying properties recently is because of the tax advantages. So if you buy a property through a company, it basically is ring-fenced within its own kind of taxable entity, so to speak. So you're paying, first of all, corporation tax rather than income tax, which is generally lower. Second of all, you are only being taxed on the actual income that the property is generating, which again means that if you're a 40% tax rate, it makes much more sense doing that. And then there's also a lot of other benefits of buying through a limited company. So taking dividends, again, is a much cheaper way, much more tax efficient way of taking money out of the business. And then there's other benefits. So if you were to say buy a property in a business and you then basically paid the business from your own personal account to then buy that property, what you've done is you've technically loaned that company the money to buy that property. So what that then means is that the rental income that you get from that property, you can then pay yourself as a loan repayment, which is actually tax-free. And obviously this will be confirmed by any sort of tax advisor that you speak to. And obviously if you are setting up a company, do speak to them first. But these are some of the benefits that you get with that.
Just on that note, Ben, I find that many of my clients, certainly the ones I had previously, were massively in favour of buying for this because it increases the resale market in the sense that people can buy these properties. You can literally sell the company as opposed to selling the property.
Yeah, exactly. And that's the other big tax advantage, is that when you come to reselling the property, so if you're selling it to another investor, they can basically buy the business rather than buy the property itself. And that means that the stamp duty in buying the business is 0.5% of the total property value.
Yeah.
So much more tax efficient than if you're buying the actual property itself.
Yeah. And would you advise clients to purchase one property per company or have multiple properties in the same company?
So I'd say that if you have obviously one company per property, that makes it much easier if you want to sell that property, because obviously if you have multiple properties within one business and then you're looking to sell one of those properties, you have to sell that normally. You can't sell it through that business vehicle. So generally it is much easier if you set up one company per property. So it means that everything is absolutely ring-fenced, and it's just a much more tax efficient way of doing it. And it gives you a lot much more freedom in terms of your choices moving forward. And
generally, in your experience, what are the typical costs associated with first of all creating a company, but then also keeping that company running ongoing.
Yeah, exactly. So obviously, when you set up a company to purchase a property, you obviously have setup fees. So you have setup fees with Company's House to actually set up the company, and then moving forward, you have to do accounts each year. You also have to, there's kind of various kind of checks and forms that you do have to fill in. So it is more time consuming, and there are additional costs that you do have. However, generally these will outweigh the additional tax that you would pay if you were buying through sole ownership.
Right. Perfect.
And then obviously, finally, if you were to set it through a company, it is generally slightly more admin than you would have to do if it was in your own personal name. And then finally, the kind of final ownership structure, which is probably not one that many people would use, but trust ownership. And this is mainly used to manage inheritance and basically allow you to pass on assets to your children, or basically put them in your child's name before they are of age to actually be able to technically own a property. So it's obviously a lot more complex to do it this way, and it is more expensive to set up. But it is a way that a lot of people do buy properties. And in fact, a lot of the benefits you get from trust ownership, you can also get through business when it comes to passing on assets and that kind of thing.
Good. I think the only thing I'd add here, guys, is that the answer to which structure you ultimately implement for your purchase will very much depend, once again, on your individual goals, objectives, your journey, and where you need to get to. And once again, we often see people following the crowd on this point as well. Oh, I'm setting up a company to buy my property. Why? Because my uncle told me to do so.
Yeah.
But my uncle's got multiple properties, is a completely different person to me, and so has more benefits than what perhaps they could get from setting up a company. Yeah. So again, look at your own individual circumstances. Talk about it with an accountant, a tax advisor, because ultimately these are the guys who will give you the right advice. And if I can give you one tip around that, the right tax advice often costs money. So if I was to advise investors, one area not to skimp, and that would be getting tax advice and good quality tax advice, because moving forward, it really will help you save quite a lot of money. And once again, just to caveat, we aren't tax advisors, and we're not qualified to give tax advice. We're giving you pointers here. But yeah, do seek the reliable advice from an IFA, from a tax advisor, or an accountant. So that concludes that section. Thanks for that, Ben. This is another section here that we thought warranted a mention, and that is whether or not we decide to leverage or not leverage.
That is the question.
Yeah. A little play on Shakespeare there, but Ben's going to again just talk you through this section and give you some pointers here.
Yeah, exactly, because I get it a lot from clients where they want to obviously purchase purchase a property with a mortgage, but actually quite often lenders have a lot of requirements about what properties they will lend to, and not every property is actually mortgageable. So I've listed a number kind of the reasons why lenders will not lend on a particular property, or why it'd be more difficult to lend actually, because not all of these points are are an absolute deadline. There will be lenders that will lend, but quite often you'll have to pay a slightly higher interest rate. So for example, commercial on the ground floor, so lenders quite often don't like the fact that if there's a shop or especially a restaurant on the ground floor, because they see that as a potential fire risk. So you can still get lending, but quite often it's at a high rate. Construction materials used. So I know that there's some banks that don't like if it was like a timber framed building or certain construction methods being used. So overexposure. And so that covers when a lender has lent to a certain number of people within a specific building. So normally, lenders will only lend to about 20% of the flats within one building. So what that means is, obviously, if you are coming into a development a bit later, quite often the larger banks may have already had their exposure quota, filled. So quite often you may need to go to another lender for that. Land zoning. So this is one that we've actually seen quite often with permitted development schemes, where essentially the local planning department will zone lands in a specific area for different purposes. So you'll have, residential, you'll have commercial, so on and so forth. So quite often with the converted properties from office blocks, quite often they're still zoned for commercial use. So it can be slightly more difficult lending on that. Not saying it's impossible, but it can be more difficult. And then obviously the next one, cladding, is one that I'm sure everyone has come about. So an external wall survey. Obviously in the wake of Grenfell, unsafe cladding has been kind of hot on the lips of a lot of people, and basically, properties that have unsafe cladding, you just can't get mortgages on. So the next one, assured rents. So this is actually quite an interesting one because, we do sell a lot of properties that have assured rents. So there are some lenders that don't mind assured rents, but there are other lenders that will often look at assured rents and say, well, this has got too many investors in it, so we're going to pull back. Doesn't mean it's impossible, but quite often means it's more difficult. And then, the size of the property. So when it comes to size, I believe that the minimum threshold for lending in the UK is generally 30 square meters, isn't it? Yeah, I think it's 30 square meters. Obviously, property condition, if you're looking to buy a property through auction, quite often you won't be able to buy that with a mortgage if it's in a dilapidated state. The value of the property. So we quite often get investors asking on properties which are below 50,000 if they can get a mortgage on it. It doesn't matter what property it is. You will not be able to get mortgages on properties below £50,000 because they see that as too high of a risk exposure. Again, high ground rents and service charges, if there's extortionate ground rent on there, lenders will quite often stay away from that. But actually, there's been some very, very good news for kind of landlords and owners alike, where they're actually going to cap ground rents at £250. I think that was literally announced a couple of days ago. And then obviously, finally, flood risk. If you're buying a property that's in a flood risk area, it will be more difficult to get finance.
Thank you for that, Benjamin. That's all very, very useful stuff. And one thing I'd like to kind of add to that is, and tying it in, I guess, to your previous structure, whichever structure, so your previous section, whichever structure you decide to purchase with will also affect the likelihood of you getting mortgage, the interest rates, etc. Company finance generally tends to be a little bit more expensive, and there are other hoops to jump through. For example, you need to prove your income and things like that as a director. Bear that in mind. It's not so much whether to leverage or not. It's more about kind of whether you're going to get the finance and whether you qualify for the finance as an individual and an investor, and also whether the property and project qualifies for finance.
Yeah, exactly. Absolutely. Sorry, can you go back to the previous slide? So absolutely, it is very, very important to definitely speak to mortgage brokers before you actually look at properties first, because they'll be able to tell you how much you're able to afford and what kind of properties you will be able to get financing on. Because, why do we buy with finance? Obviously, you maximise your returns on capital. If you've got, say, £200,000 rather than buying one property in cash, you could potentially buy 2 or maybe even 3 properties by putting down deposits and maximising leverage. And then obviously you can then refinance properties at a later date when the value is higher, take money out, buy further properties, and that's how you build a portfolio very, very quickly. However, whilst there are kind of big benefits to that, there are obviously higher risks when you do buy with mortgages naturally. So, some of the big issues with buying with finance is, first of all, overexposing yourself. So quite often, if you are looking to try and build a portfolio too quickly, you can maybe be slightly ambitious and try and buy too many properties at once, whereas actually making sure that you can purchase properties which are affordable for your income is definitely the best way. Also fluctuating interest rates, because interest rates are obviously quite high at the moment, so you need to make sure that when you buy a property, you buy it for a fixed term, and also know that you can afford any rises moving forward. Again, dealing with lenders. Lenders are never easy to deal with. And, as I mentioned on the previous page, there are lots of different reasons why they'll make it more difficult to lend on a property. And then, the other things like less flexibility, hidden costs. And obviously, if you aren't able to repay the mortgage, then you risk losing the house and the deposit that you've put in.
Thank you, Ben. Right, on to the last section, which is taxation. Two things you're guaranteed in life are death and taxes. So we thought we would put a little section in about this. Before I do so, however, I'm just going to ask you guys another quick question, because I'm always keen to know where you guys are at currently. What is the biggest concern you are having about investing in UK property at the moment? If you can all answer that, that would be great. So taxation. Unfortunately, guys, I was hoping we would get our tax advisor in to do a short piece on this, and he was due to come in and talk to you guys in a bit more detail, but sadly his little boy was unwell and has to look after him, so apologies about that. We'll try and get them next time. But really what I'm going to do here is just run you through very quickly the taxes involved with buying a property. So first one, perhaps the most obvious one, is stamp duty. Now, I'm going to share with you a humorous event that took place at Opulent a few days ago. Now, stamp duty is one of those things that actually even solicitors get wrong sometimes.
Yeah.
I can tell you now on a particular issue relating to stamp duty with student accommodation property in particular. I spoke to 4 separate solicitors yesterday, and each of those solicitors gave me different advice. And so it can be a grey area, particularly if you're investing from overseas, or you're investing as a buy-to-let investor. It can get a bit tricky. So do your homework here. Don't necessarily rely on your solicitor's advice. The guys who will really give you the definitive on stamp duty, probably a tax advisor, or again an accountant. But stamp duty rates, again, they're always evolving, they're always changing. Now, the issue we had with our solicitors was based on student accommodation, and in a nutshell, the debate was whether or not international investors, when purchasing student accommodation, would be liable to pay the 2% premium, being an overseas investor or not. And still, kind of 2 days later, we still don't know the answer to this. But hence why we say, look into stamp duty, do your planning around this, because it can get quite costly. Next one is rental income tax. Ben touched on this a little bit before, but it's about how your rental income is taxed. We get a lot of investors, particularly ones from overseas, that seem to forget or omit the fact that they have to pay taxes here in the UK. Everyone who derives an income from here, here being the UK, will have to pay income tax. Again, speak to an accountant, speak to a tax advisor about this. The rates are going to vary depending on your own individual circumstances. Capital gains tax, that relates to the tax that is applied to the profit you made on the sale or disposal of your property investment property. Some good news about this actually in the Chancellor's budget, in that capital gains tax is coming down, which is good news. So yeah, keep your eye on that. Any gain you make on your property from the point at which you purchased it to when you sell it will be taxed. And so you need to consider that. Council tax, again, another one that people seem to forget, but here's a good pointer for you. Council tax is paid by your tenant. unless you don't have a tenant. Another big one where a lot of our clients fall down, if your property is vacant or empty, or there is a void, then you as the investor, as the landlord, will need to pay the council tax. Otherwise, you will get numerous letters through the post requesting you to pay, etc. So bear that in mind. Inheritance tax. Inheritance tax is a very complicated one, so I'm not going to talk too much about it. Jazz, who's our tax advisor, would have spoken about this in more detail. But again, depending on how you invest, the structure you invested, there's going to be this to consider, particularly if you're looking at leaving your portfolio for your children. And the last two are quite obvious: VAT and land and building transaction tax, which more often than not will not apply to your average buy-to-let investor. So that is taxation. What we would advise is to again speak to a qualified tax advisor, consult an accountant, keep abreast of changes in taxation, notably in the Chancellor's budget. Look into creating a company if that's what's best suited for you, and then budget costs when you're buying a property. That, in a nutshell, is the taxation side. And very quickly, because I know we're running short on time, Ben's going to talk to you about the importance of using a reputable management company. We've touched on this throughout today's webinar, but Ben, if you may very quickly just run through this section.
Yeah, exactly, absolutely. Because choosing a management company that first of all keeps on top of all the compliance is absolutely key. Making sure that they're up to date with chasing tenancy, sort of rental payments as well. Because quite often, we've had investors who've had rental payments that haven't been chased up and they're missing income for 3 months. Also finding better quality tenants. As well, because if you have a management company that specialises in doing that, they will make sure that the quality of tenant that you're getting is much better. They will pay the rents on time. They've had background checks. They've had credit checks done on them. It also means lower void periods, improved tenant retention quite often, because if the management company is performing well and looking after the tenants, which in fact is very important because the tenant is your customer. That means the tenant will stay at that property for longer. Also, keeping on top of maintenance issues means that your property won't wear and tear as much. And also when it comes to evictions. So if your tenant is not, paying the rent on time, is playing up, they will know the process of being able to get rid of them and getting a better tenant in. It's also much less stress as well when you have a property manager, because they do all of the legwork and you simply sit back and enjoy your returns. Introducing the total property solution from Opulent. So I've been letting properties for a number of years now. It's been a very successful arm of our business, and we can sort out all of these issues for you and make investing hassle-free.
Correct. And thanks for that, Ben. And just to elaborate a bit more about the total property investment solution. In fact, everything we've spoken to you about today, ladies and gents, inspired us to create this. We're often dealing with investors from all over the world. They're very busy. They have high-flying jobs. They want to invest in property, but they don't want all of the headache and all of the rigmarole and paperwork and stuff like that comes with it. So we created the total property investment solution. That means you use us for your research. You use us to buy the property. You use us to let the property, manage the property, and then remarket the property, and then resell it, and then go again. So the whole 360-degree turnkey solution, providing you with one point of contact throughout and simplifying the entire property investment journey, so to speak. So that's our total property investment solution. This is how we can help. Again, we're a lot of this can be quite cumbersome and tedious when you're doing it yourself. You need to be on point. You need to be on the ball. Otherwise, it will cost you lots of money. The alternative is you partner up with a company like ourselves who do this sort of research day in, day out. We know exactly what we're looking for and have a demonstrable track record of being able to assist property investors get round all of this nitty-gritty stuff, but then also achieve above average yields and capital appreciation above average. Here's a little bit about us. I'm not going to spend too much on this, but we as a company, we sell residential property. We understand at the moment now interest rates are quite high, and so we're focusing a lot on commuter belt areas that are less known, i.e. we're not following the crowd. We're taking our own advice and not following the crowd, and finding areas where there is evidence of good regeneration, capital appreciation, population growth, that prices are still low, and that in 5 or 6 years' time they may increase 30%, 40%. These are the types of properties we're looking at. We have one at the moment in Stafford, which is a fantastic property. It's completed, it's tenanted. Prices start from just under £100,000. Mortgages are available. This project is prime for people who are new to buy-to-let property, just dipping their toes in the water. You need, I think, 35 to 40k, including all of your costs, to purchase a unit here. They're already tenanted. They're already going to generate you an income. Here's another example of a type of property we've just launched, which is a buy-to-let project in Uxbridge. With us, we're always looking for angles. We're always looking at ways our clients can make money day one. With this, we are selling property in London the same price as property in Manchester. Why? Because the developer has frozen his prices for 5 years. And so investors on this particular project can earn up to, I would say, £30,000 to £40,000 in instant equity on day one. Why? Because the market has moved since when the developer started selling these way back. He then took them off the market and started reselling them. But the idea is there's instant equity built in on day one. So another project, very, very good. One beds on here, they start from 290 grand.
And also just a quick point on this particular project. We actually had a client who was reletting their property recently. We put it on the market at 1,400 for a one bed. We had over 120 inquiries in 2 days. Mm-hmm. We eventually let it for 1,500, which would give you a yield of over 6% in London, which is very rare.
Indeed. Thanks for that, Ben. We also look at student accommodation units. The student market is growing. More and more people are coming here to study each year, and there's a shortage of beds. So we sell student accommodation pods, which are often 15 to 20 square meters, all encompassing self-sufficient desk, bed, ensuite. They start from as little as £50,000. They are cash purchases, but again, they're completed, operational, very low risk. So that is again type of properties that we're selling. Our new one, this is fresh. This one, it hasn't actually hit the market. We signed it off 3 days ago. We're busy creating all of the marketing, but this will be Leicester city centre, and it will be a buy-to-let opportunity with prices starting from 140k. This one is going to be a very good seller, Leicester's always been one of those areas that our investors and other investors they enjoy. Guys, I'm going to pop something else on your screen. Here's an opportunity for you to have a 15-minute consultation with one of our consultants. If there's anything you're unsure about, anything you want to learn more about that we perhaps couldn't discuss in too much detail here, click the link below, book a 15-20 minute, however long you want, consultation with one of us, and we'll help you unravel more the wonderful world that is property investment. That then brings us to the end of the webinar today. We hope you found it very useful, guys. We're going to have a very quick question and answer session now. So we've been asked questions throughout, some of which you can see, some of which you can't. So I'm going to start with the first question, and the first question we got is, which locations are currently the growth area? If you've got any other questions, guys, and you want us to answer them right now, feel free to drop them in the group. But the answer to this, again, we need a long time. But I think the answer to this lies to some extent in not following the crowd, and that is doing your research, finding the right locations where there is evidence of regeneration, population growth, and a strong local economy. And there are pockets of places like this. But I'll be honest with you, they aren't necessarily the areas that the media are going to tell you about, that your friends are going to tell you about. These are the areas that we have done research on and that we are actively encouraging our investors to invest in, because we know, based on what lies ahead, they're getting into a market early, i.e. they're buying low. And then when the mainstream come, because they've seen it in the newspaper or whatever, they sell and they cash in. We've got a lot of areas. Stafford is one of them. Birmingham commuter belt areas, London commuter belt areas are very popular at the minute. Places like Windsor, Uxbridge, these kind of zone 6 areas on the periphery of London, where people from central London are moving out to in favour of better value for money, because they no longer need to be in the office every day due to COVID, things like that. So if there's anything else you want to ask us about that, again, feel free to book a consultation. We'll happily share with you the reams of research and results we have on where we think is the next property hotspot.
I want to know exactly. I was going to say, like, another question that's come up. How do you keep on top of all of the legislation? I mean, a lot of the new changes are obviously kind of sort of relayed in the media, but if you look at HMRC's website, for example, they've got up to date, sort of advice on kind of what taxes you have to pay and the guidelines in terms of landlords, what legislation they need, and also if you need kind of to be updated on all of this, just speak with a management company. They'll be able to help you.
Yeah, absolutely. And so there's a few more questions here. One's commented on what types of properties we sell as Opulent. Hopefully the last few slides of the presentation gave you an idea, but the general gist of it is, wherever we believe the 4 pillars to a successful property investment have been met, we will market that project, be it a commercial property in student accommodation, be it residential, be it off plan, or be it completed property. We will get involved in all of it, as long as it makes sense for our investors and helps meet our investors' requirements and helps add value to the journey that they want to go to. So yeah, that's us, guys. Thank you very much for taking the time out of your very busy days to come along here and learn a bit more about property investment. Thank you, Ben, for taking the time out to join us. We're going to be running these monthly, guys. If you've got any ideas on what you'd like us to talk about next, feel free to drop us an email. Our email address is going to come up here. It's info@opulentinvest.com. Feel free to book a consultation. The idea with these guys is we're giving you some really good content, tips and pointers about what you want to listen to. So we're always open to listening to what you want us to talk about. If you're watching us on YouTube, you're watching a repeat on this, please feel free to like the video, share it, and spread the love. But yeah, for us, guys, that's it for today. And thank you. And we wish you the very best of luck for the rest of your day.
Thank you very much, guys.